This question comes from @ScottMetzger7621. The question here is, does keeping 3 or 4 years in cash solve the problem of selling stocks during a retirement bear market? Yes, it can, for sure. I talked about this a few times on the Clips channel already and in videos. The core concept here is, do we need an actual large cash buffer? It depends on how you define your portfolio, and I think people can make a big mistake here. The big mistake here is having an asset allocation that already has conservative investments in it that act as a cash buffer that we just don't know act as a cash buffer. I've seen that happen a lot. So if you have a 60-40 portfolio, let's just say, some of that 40% of your quote unquote safety is going to be in bonds. And some of it's going to be in very short-term bonds that are basically the equivalent of a high-yield savings account or a money market fund, or maybe are even in a money market fund or a high-yield savings account. Now, if we don't know that, and we then therefore go stockpile a bunch more cash into a cash, quote unquote, cash bucket, well, now we've just taken our asset allocation and made it actually much more conservative, which is fine if you know that that's what you're doing and that's exactly what you want to do. But you may not have needed to do that, right? So if someone's let's say in a 50-50 allocation and they have $1 million and they decide they need to stock up 4 years of spending, so let's call it $50,000 a year of spending. So let's call it $200,000 for 4 years of spending in a cash bucket. And now what they do is over the next kind of years of their working life, actually forget, let's make it even simpler. They have this $1 million, they reallocate $200,000 of it to a cash bucket. They literally take it out of a pre-tax account, put it into a high-yield savings account, whatever. And they rebalance their portfolio such that that portfolio stays 50-50, kind of not having made the connection. Well, now they have $500,000 in their conservative tilt in the portfolio and $200,000 in cash. They have $700,000 in the conservative tilt total, $500,000 in the more growth-oriented tilt. And now their allocation is much more like a 70-30 or a 30-70 than a 50-50. And maybe now they can't meet their rate of return requirements in retirement. I don't know. So the point is just like it's totally usable as a strategy, but like it has to be very thoughtfully applied in the sense that my opinion is a well-constructed asset allocation already has an element of bucketing in it. It already has a cash bucket style element in it. It just needs to be explained that way and disclosed. So a lot of this is more about perception and disclosure, understanding how the tool is constructed. And that would, again, this all leads back to anxiety gets solved by having better understanding of things. So if we understood our portfolio allocations or they were explained to us more clearly or transparently, we might feel differently about some of these concepts. But yes, you could definitely make the case that a dedicated cash bucket, as long as you consider that a part of your total allocation, would be useful in preventing sequence of returns risk such that you don't have to sell stocks while things go down. Another quick thought just about this subject. I've done an example of this on my channel, but like not all stocks go down at the same time. During the great financial crisis in 2008, during 2022 when interest rates rose, and Ukraine war and all these different times, you did not see all stocks go down at the same time. I did a really good example of this on the channel at some point where I showed that during 2022, Meta stock, for instance, went down something like 67% from January through October. And at the same time, Kroger went up 6.7%. It's like modest increase, but like they were completely inversely correlated. And if we just look at all stocks as having the same correlation and the same beta and standard deviation and all that other stuff, like we are misleading ourselves. And so it could have been a totally viable strategy to actually sell Kroger to produce income. I'm not recommending anyone do that. I'm just saying it could have been a viable strategy at that time to have sold Kroger rather than depleting a cash bucket. Because if Kroger was up, we might want to consider taking profits from a position that's up. If I don't know, assuming not the tax consequences notwithstanding, but it's just an illustration of like there's more complexity to this than we're being led to believe. It's worth thinking through some of these layers of complexity. But great question. Thank you for the question @ScottMetzger7621. Real quick, let me show you the exact 3-pillar comprehensive retirement roadmap that takes retirees from uncertainty to peace of mind that less than 1% of retirees actually have in place. Now, I've built hundreds of these for retirees, and I can say with a high degree of confidence that these are the 3 pillars every retiree needs to have in place in order to have full confidence that they're not missing anything in their retirement plan. And I broke each of these down by the specific questions. You can see them here that each needs to be answered and the best way to answer them. Now, we've done this across pre-retirees, recent retirees, married couples, single retirees, $1 million portfolios, $10 million portfolios, all the above, and it works. And it's my gift to you today. It's absolutely free. It's in the first link in the description below this video. It's going to say free comprehensive retirement roadmap training. Just click the link, enter your info, and you'll get instant access all for free.